Did you know the Federal Reserve just cut interest rates for the third time this year? If you're wondering what this means for your mortgage, credit cards, or savings account, you're in the right place. Today, I'm breaking down the Fed's interest rate cuts in the simplest way possible. Hey everyone, welcome back! Today we're talking about the Federal Reserve interest rate cuts 2025 and exactly why they happened. By the end of this video, you'll understand how Fed rate cuts affect your wallet and what's coming next in 2025. Let's dive in. So why did the Federal Reserve cut interest rates? Think of the Fed like the thermostat for the entire US economy. Their job is to keep two things balanced: keeping prices stable so inflation doesn't run wild, and making sure people can find jobs. Here's what happened. After inflation hit a 40-year high back in 2022, the Fed raised interest rates aggressively to cool things down. They pushed rates up to their highest level in 23 years. Fast forward to 2024, and inflation has dropped significantly, getting much closer to the Fed's 2% target. At the same time, the job market started slowing down, with fewer job openings and hiring rates dropping. The Fed realized it was time to shift gears. They cut rates in September by a half point, then again in November and December by a quarter point each. That brings the current federal funds rate to between 4.25% and 4.5%. The goal: support economic growth and protect jobs without letting inflation heat up again. Now let's talk about what Fed rate cuts mean for your money, because this directly impacts your daily life. When the Fed cuts interest rates, borrowing money becomes cheaper. That means lower interest rates on mortgages, car loans, and credit cards over time. If you've been thinking about buying a house or refinancing your mortgage, rate cuts could save you thousands of dollars. Same thing with auto loans and credit card debt. For businesses, lower borrowing costs mean it's easier to expand, hire new employees, and invest in growth. That's good news for the overall economy and job security. But here's the catch. If you're a saver with money in a high-yield savings account, you might see your interest earnings go down as rates drop. The Fed giveth and the Fed taketh away, depending on whether you're borrowing or saving. One more thing, the stock market tends to react positively to rate cuts when the economy stays healthy, because companies can grow more easily with cheaper money. What's next in 2025? So, what can you expect for Federal Reserve interest rates in 2025? The Fed has signaled they're going to slow down. Instead of the 4 cuts they originally planned, they're now projecting just 2 rate cuts next year. Why the caution? Inflation is still a bit sticky at 2.7%, above their 2% goal. Plus, there's uncertainty about how new economic policies might affect prices. The Fed wants to make sure they don't cut rates too fast and accidentally cause inflation to spike again. Bottom line, higher for longer is the new motto. Rates will come down gradually, but don't expect them to drop back to the near-zero levels we saw during the pandemic anytime soon. And that's why the Fed cut interest rates in simple terms. If you found this helpful, smash that like button and subscribe for more easy explanations of the economy. Drop a comment below. Are you happy about the rate cuts, or were you hoping they'd go further? I'll see you in the next video.